So, how to pay your life insurance premiums with a bank instead of out of your own pocket? It is the number one wow factor that I give any client. Whenever I'm talking to a medium net worth client or a high net worth client, and I'm just like, hey, you want to put 50 grand, 100 grand, $1 million a year, a month into a policy. Well, like, what if we could leverage a bank and someone else pay your premiums? You take the money that you were going to put into it, put it back into your business, put it back into whatever, earning a better interest rate because your life insurance is only going to earn you about 6 to 7%. So if I can take my millions or my hundreds of thousands and I can put it somewhere in my business earning 20%, earning 10% instead of earning 6%, it makes a lot of sense. So what I'm going to show you today is how we get a bank to pay our premiums for our cash value life insurance policy. It sounds really sexy, but stay with me because at the end, there's very important details that you need to understand to even see if this is something that you would qualify for. So here are the five most popular reasons why people finance their life insurance. Number one, they want to use other people's money. If you're a real estate investor or you use banks in any way, shape, or form, hard money lending, or just creative financing, you understand that if I don't have to put my money into the deal, it's a sweeter deal because now my money is doing whatever I want it to do. Someone else's money is making me money, and I can just pay them a little dividend on the back end. So using other people's money, that's number one. Number two, and people absolutely love financing their policies for this reason, is getting out of an asset. So let's say that you own an apartment complex that's worth $5 million. Well, if you sell that $5 million apartment complex today, what do you have? $5 million of taxable income. You can put that into a charitable remainder trust. You can forego the taxes on that forever. As you draw guaranteed income, now you pay taxes. But if you want to put it somewhere where it's tax free, you legally cannot take that 5 million and stuff it into anything tax free. But what you can do is have an exit plan. Hey, I have a $5 million apartment complex. In 5 years, I would like to exit that apartment complex. So let's say we put $750,000 into a policy for 5 years. And after that 5 years, we have a little more than $4 million in cash value. You sell that property of 5 million bucks, we pay the bank back. And now that $5 million gain that you had, instead of paying the taxes and having $4 million of taxable income. So if you were to invest it somewhere, now it's going to accrue taxes long term, short term, it doesn't matter. But since we strategically put it into a life insurance policy for 5 years and then we exited the bank, now you foregone all the rules of, hey, I can't put this into a tax free account. So, real quick example, I had a client who had $10 million of property, land, and they're like, hey, it's going to take me like 8 years to sell this thing. So, what we did is after taxes, we assumed he would have about $7 million left after depreciation, after all the things we could do to bring down that tax. So, $7 million over 8 years, we did about $900,000 per year over 7 years. On that eighth year, when he sold the asset, he took that post tax gain, paid off the bank, and now he had that exact dollar amount sitting in his bank account, completely tax free. He can use it as becoming his own bank, infinite banking concept. I don't like that term, but you can do it that way. You can turn on a guaranteed income for life. So, the number one reason why you would ever want to use cash value life insurance is the income that it provides. So, if I have $10 million in my cash value of my cash value life insurance policy, I can safely take 5 to 8%. Why do I say 5 to 8%? If I take 5% income, my cash value will keep growing as I take it to where my income can go up like a cost of living adjustment. So a lot of financial advisors say there's no cost of living adjustment. So if you safely took 8%, now everyone else is starting at a 4% safe withdrawal rate, the 4% rule, but you start at an 8%. For one, this is taxable. Their 401ks, their IRAs, the managed money is taxable. You're getting 8% tax free. So let's back up. If you have $10 million of cash value, you can take $800,000 per year tax free. It's a little less than $70,000 per month forever. These policies, if done correctly, if structured correctly, if taken income correctly, will give you income until 120 years old. Number three is hyper funding a policy, accelerating the growth. If I can put $100,000 a year into a policy and the interest payment on a bank loan to put into that policy is roughly 100 grand, that multiplier is like 900,000 to $1 million. So if the bank can put in a million, I only pay 100,000 on the interest only. Now that $900,000 is compounding, that $1 million is compounding. So in 5 years, when I exit that loan, instead of having $500,000 in my cash value because I put 100 grand per year, I put $5 million over that lifetime. I exit the loan via an asset sale or the cash value. Now I have $5 million compounding and not 500,000. So if I'm earning 5% interest on 500,000 versus 5% interest on 5 million, makes all the sense in the world, right? So using other people's money to accelerate their growth. And really, number four is the most strategic way to make sure that your retirement accounts are not just destroying you with required minimum distributions, with your Social Security being 80% taxable, with putting you in the 24, 32, 30, 37% tax bracket. What do I mean by that? I've had people that saved their whole life into like a solo 401k and a solo or just all these different things to where they're piling tons of cash into a pre-tax account, kicking the can down the road. So today they're getting the tax deduction of $50,000, but that $50,000 they might have saved 15,000, maybe $20,000 worth of tax. Down the road, when that compounds, they're going to pay 100, 200 grand of taxes on that same money. So why is this important? Let's say you're 60 years old and you saved up $5 million into taxable accounts. 4% income on that. That's $200,000 of taxable income. Well, now you're like, my tax bracket's insane. I do have my Social Security is going to be 80% taxable. I will have required minimum distributions or RMDs. So, how do I fix this? One, we can do Roth conversions. That's a completely different conversation. You take that money, you convert it, some of it into Roth, maybe half of it. That way, your tax bracket's lower, about the same amount of income because your Roth is post-tax and your traditional is not. But what we like to use premium financing for is, hey, you can't shove a bunch of money into a Roth 401k because most people don't even have access to a Roth 401k. A Roth IRA has very, very low contribution limits. And if you make more than $250,000 as a couple, you can't even contribute to a Roth IRA. So cash value life insurance is literally the only way to put money away, grow it tax free, take tax free income with no limitations. Really, the only limitations are your income and your net worth. So if you make $1 million a year, you can't put $700,000 a year into a policy, but you could put $300,000 a year into a policy. So this is important because if you're 60 with $5 million, what if we can fund with a bank into your cash value life insurance policy over 5 years? When you turn 65, we can exit via stocks, via sale of a house because we're downgrading, sold a business, whatever that looks like. And now I have hundreds of thousands or millions of dollars in cash value that is tax free. So my foundation before was all 401k. It was all taxable income. Now my foundation is tax-free, nearly guaranteed income with cash value life insurance. It's way stronger, it's more predictable, and above that, now we can do things like Roth conversions. So now this side is a Roth converted guaranteed income. On this side, we can have your traditional accounts because we still want to take your standard deduction. You put some money away pre-tax, got the deduction, but with the standard deduction in the future, we can take that income tax free because the government allows us to take $32,000 a year tax free as a married couple. So, again, having that baseline of something tax free is very, very important. And if we are 60, 62, even 65, and we're like, man, I did not plan well, or my financial advisor put me in all pre tax accounts and just managed money and brokerage accounts. So my tax bill is going to be even bigger in retirement. One side note, the number one thing I do not like about financial professionals, financial advisors, financial planners is they are told you are not a tax attorney, you are not a CPA, you are not a Social Security genius, you are not a professional. All these things that are so, so important to your retirement, they won't touch it with a 10-foot pole. Why? Because it makes the conversation harder. It makes the portfolio need to be a little bit better than just throw all of my money into some balanced asset that they put together, earning you an average of 8%. I could get down the rabbit hole of average versus actual versus managed money versus pre tax versus post tax. But for now, I'm just telling you, most advisors have a very cookie cutter approach, even if they're independent. If they're not independent, if they're captive, if they work for like Edward Jones or JP Morgan Chase, they have to follow a certain guideline. They can only use certain providers. They can only use certain life insurance carriers. They can only use certain annuity carriers. So, whenever you're independent like myself, you have the whole entire industry that you can reach out and say, this client needs this. So, I got this. This client needs this. I can get that. Why? Because I'm not captive. I'm not using somebody else's name like JP Morgan, Chase, whatever, to be able to say, like, look at me, I have accreditation. I can just say, I'm good at what I do. Here's the plan. Do you like it? And most of the time, people love it. They're like, I don't even know how this exists. And at the end of the day, it is no matter if someone's been in the industry for 5, 10, 20, even 50 years, I've seen people that have no clue what I'm talking about. They know talking points. Somebody on the internet, somebody at a seminar, at a chicken dinner webinar seminar said, hey, premium finance is wrong. And that's it. They never went into the details. Or they'll say it's dangerous because the loan. A loan is a loan. If you don't pay it back, it's dangerous. But again, this is so important. So I'm going to go into the fifth reason. And number five is legacy planning and estate planning. I know it's very common sense. Life insurance is a form of estate planning. It just is. It's probably the number one form of estate planning. So the reason why we would finance a policy is because let's say someone is, and we ran into this the other day, someone's 70 years old, and this is like a very fine line at 70. We may not finance a policy because their health is just not worth it. But let's say 60. 60, you accrued all of this net worth, this massive taxable income, taxable accounts. You're worth $100 million. If you didn't know right now, as of right now, let's just say $28 million as a married couple, your first $28 million in net worth will transfer tax free to your family. If you're worth $100 million, that means $72 million is taxable by the IRS at 40%. Crazy, huh? I met with someone who was worth 36 million bucks. They had a credit union running their accounts for 40 years. I got on the phone with this guy. He's old school. He's like 70. He's gritty. He's done real estate. He's roofed houses. He's done everything his whole life that you can tell he's just a man's man. His daughter told me, hey, talk to him. He's probably going to shut you down just to let you know. I'm like, I love that because that's where I came from. I came from blue collar. I understand these people. The first thing he said is, I don't need anything. My credit union runs everything. And I was like, hey, just so you know, your daughter thinks you're worth about $10 million. I don't really care what you're worth, but I do know that a lot of people don't understand estate planning and they don't understand gifting and the tax that you would have to pay, the estate tax, if you have too much net worth. And he goes, well, don't tell her, but I'm worth about 36 million. And I was like, sir, you do realize that 14 million is the estate tax exemption. So that means 36 minus 14, $22 million will be taxable. That's roughly 9 million bucks goes to the IRS tomorrow if you die. Is that something that you plan for? And the dude almost cried. For 30 seconds, he didn't talk. And I knew if it was anyone else, I would have butted in and been like, hey, man, are you there? Did I lose you? Did it cut out? Because I'm walking at the time. And I waited. And he just had this gravelly voice, like he had tears in his throat. He's like, let me get back with you. This is frustrating. Took him a month. He's like, I called immediately. I talked to my advisor. I talked to the branch manager. I even talked to the president of the bank. And guess what? They all completely confirmed everything that you said. I was mad for like the last month, completely infuriated. I didn't even know what to do. But now I'm ready to plan. So again, the reason why I even bring this up, the reason why I bring up that example, that client was going to have a $9 million taxable estate tax. The problem is, since he was so old, we didn't have enough time to roll out his assets into irrevocable trust to get him out of his balance sheet. So we had to plan the other way. We knew that if he lived about 10 years, we could get most of that estate tax out of his name. But what we did is we financed a policy for death benefit. We did not want cash value at all. We said this guy needs at least $10 million of death benefit. What does that look like? Came out to like $400,000 a year. So we had a bank pay the $400,000 per year. He paid the interest only payment, which again, don't quote me on this because I'm not a financial advisor. Um, he paid the interest only payment. It was tax deductible through his business because he still owned a real estate business with his daughter. And if he passes away with the cash value growth today, he would have about $10,500,000 of death benefit. But here's another kicker. There's a lot of advisors that will do that knowing that they can't set up an irrevocable life insurance trust and get paid off of it. So they will put that $10 million back into your taxable estate. So that $10 million of death benefit that we just got to fix your problems, it's taxable at 40%. So you walk away with 6 million bucks. So there's still a $3 million tax that's due. Insane, right? So what you would do is you would structure that policy, get the death benefit, leave it to an ILIT, an irrevocable life insurance trust. Now that trust can pay the taxes and it's completely out of your estate. So it's completely tax free. It's not on the balance sheet. We can take 9 million, pay the estate tax if he passes away soon, still $1 million left in that ILIT. And we can dictate the language within that trust to say, I only want it to go to an interest bearing account. No one can touch this for 15 years. Or we can say, I want to leave it to the grandkids. But here's a stipulation. I want it to be a complex trust because if the kid gets on drugs, I don't want them to take a dime until they are sober for 3 months. If the child does not have a full-time job, I'm going to make that child go back to work full-time, at least part-time. If they get a part-time job and they keep it for a month, now they can have income. And then the number one reason why you want a complex trust, meaning there's not a fixed payment going to that person, is simply because you want to make sure that in the case of a divorce, which right now like 80% of marriages are ending in divorce, they don't have access to that trust. If you had a simple trust that paid you $40,000 per year, never missed a beat, now that becomes part of your assets. So the $20,000 would go to spouse, $20,000 would stay with the child. So again, I hope all this is making sense. I hope it's not just blowing your mind. You're really deep into this video. I believe we're 16 minutes into it. What I'm going to do is go into an actual illustration. Again, an illustration is just that. It's illustrating what ifs. If the market's done what it's done the last 25 years, if our loan rate stays at about a 5 to 6% rate, if we earn this rate plus this interest rate plus if all this happens the way it's happened the last 25 years, this is what we can expect. So again, please don't think this is gospel. So if you've stomached my rambling long enough, I'm going to walk through this really quick. This is just a simple, basic design for someone that wanted to escape a taxable asset in the future. Like I said, they have land in 7, 8, in this case, 10 years. They want to exit that taxable event and put it into a tax-free account. Again, you legally cannot dump it in one time. Like the least that you're supposed to put into a policy is for 5 years. So this way we're doing it for 10 years. I'm going to walk through this as quickly as possible, but try to make it understandable. Again, we're putting a bank's money into a life insurance policy. So what happens when you get a loan? There has to be collateral. What happens with collateral? If they call the loan, the collateral is theirs. So this is why I said stay to the end, because this is very important. All this sounds super sexy. Everyone's like, yes, is this for me? So before I go too much further, before you sit through this whole presentation and get excited, I want you to know that you can only do this if you plan on contributing at least, and I mean at least $50,000 per year into a policy. Now, if we put $100,000 a year into a policy through a bank, the interest only payment at 6.5 would just be 6,500 the first year. But if we fund this for 10 years, your interest only payment could be $65,000 a year. So we need to understand, unless you're putting upper 5, lower 6, and even 7 or 8 figures per year towards a policy, don't even watch this. Now, if you want to watch this and you like the idea and you know some wealthy people that you could show this to, great. I want you to walk through this. So the first year's premium is just a random number. The reason why is we're going for this $6 million death benefit to pay off any kind of debt that's owed on this asset before he exits it. So that's the number one reason why we chose a flat $6 million. With that, the premium is $487,000. So the bank says, hey, Dustin, here's your loan, 487. We're putting it straight towards the cash value. We are not handing this to you because it's a contract between me and your life insurance carrier. You're just the middleman. You're the insured person. So part of this death benefit, if you were to die day one, I get this question all the time, 6,033,000, 487 plus interest would go back to pay the bank off. The other 5.5 million would go to your family. So again, day one, it's kind of a win. CSV, this means cash value. This basically means that the cash value, 453,000, if we lowered the expenses like we did, we always set up these policies to where the expenses, The costs, the commissions are absolutely basically nothing. Like whatever we can get away with to shrink that, we're going to do. Why? A lot of people look at me cross-eyed when I say this, and you'd be surprised how much business I lose because I say this. I want this to work so good for you that you wake up every morning saying, "There's no way this is real. I might have got scammed. There's no way. This is so awesome. There's no way it's real." You know what? I want to send every person that I know towards Dustin. I would rather eat 10 grapes than have one fat watermelon and then get sued or this not live up to your standards. So, again, $453,000 of cash value. That means that there needs to be a collateral assignment of at least $34,000. So the delta, the difference between your cash value and how much was put in, the cash value is held captive by the bank because they're saying if you die tomorrow, or if we want to call this loan tomorrow, which has happened, but it's very, very rare, we're going to take that cash value plus the $34,000 of collateral you have somewhere, whatever it is. It can be a brokerage account, it can be a checking account sitting somewhere as long as it's not touched. It can be the equity on a home. It can be just about anything that has value that's semi-liquid. You can have as that collateral. So again, cash value minus premium equals your collateral. The number one collateral that you can use, so I'm telling you, if you have this, you should think this is what I'm going to use, is a brokerage account. If you have a brokerage account worth round numbers, $1 million, and it's earning 10%, and you are collateralizing that account, it doesn't move and it's still averaging 10%. So why not collateralize something that is literally physically gaining value? And then once that collateral disappears, like I'm going to show you in a minute, it's completely free and clear. You never had to touch it. There was no fees on it. It wasn't like an apartment complex or a rental that no one could live in because the bank didn't want someone there. So this is probably the most important column because it depends on how you want to fund this. It's completely different for every single person. Some people want to pay interest only. It's like, hey, I will throw money at interest all day. I just wanted to get out of this as cheap as possible. That's like the most popular route. But then there's some people that are like, hey, if the interest only payment is 6.52% at $31,000 and I put 100 grand in, I'm actually wanting to pay down the principal $69,000 with 100,000 premium. So what does that mean? I'm putting 100 grand towards this loan for 5 years. So here, 100,000 times five. I'm only putting $500,000 towards a total of it's like a little over 5 million bucks. So I'm putting 10% in while my money compounds at a $5 million cash value. So a lot of people do like to just pay interest only, which would mean the 31,785. They're going to write a check to the bank for that exact dollar amount, and they're going to do that for 10 years. So again, how you exit the loan dictates how you pay the interest. If you're like, hey, in 5 years, I'm going to sell this asset, then you want to pay the least amount of interest as possible. Let that asset pay off the loan. But if you're like, hey, I'm going to pay this over 10 years because I want to hold this as long as possible because I don't have an asset. So a lot of people look at me like, hey, what if I don't have an asset? Well, in 10 years, if there's $5.2 million of cash value and you owe the bank 5 million bucks, let's borrow 5 million from our cash value, pay the bank off. Yes, we only have $200,000 of cash value now, but we are earning interest at $5.3 million. So if we earn 10% interest, we get credited $500,000. So people look at cash value at 200 grand. They're like, what am I going to do with that? I paid 500 grand in interest. Why would I do that? It's because with cash value life insurance, you are earning interest off of the original balance, not the cash value. So this is one thing. I probably should do this a little more sexy, but here we go. Let's say cash value life insurance is a HELOC. Your home is worth 5 million bucks, but you take a HELOC of $200,000 per year. I'm going to take that loan from the HELOC. Your house is still worth 5 million. It's still growing. It's still appreciating at 5 million bucks. You're just stripping equity to pay yourself income. So with cash value life insurance, you have cash value, millions of dollars, or surrender value is going to be your cash value. That's what you actually pull income from. Then you're going to have your accumulated value. Your accumulated value is on paper, what is your policy worth? Your surrender value or cash value is how much can I take? So again, our accumulated value is home. Our cash value is HELOC, what value can we pull? So again, this all ties back to how do I pay off the loan? What type of interest do I pay? How do I overpay it and pay down some of the principal? It's completely different for every single person. So a lot of these questions get asked on calls, and for some reason I have major issues with over explaining everything. So again, this video probably should have been about 7 minutes long, but I hate it when I watch a video and I have hundreds of questions. I get halfway through and I'm like, this would have been great, but if I just understood the first half, I would watch the rest of it. I should not project my values and how that I watch content on other people, but I hope you appreciate it that I'm trying to walk through absolutely everything that I know to walk through to help you understand this. So as we move on, you're not looking back. So let's just move on in this column. We're assuming a 6.52% interest rate, a floating rate, meaning again, we don't know what interest rates are going to do, but we hope that it will go down. And if it does go down to like a 5%, we want to lock in that rate because if we're starting at like 8%, which was like a year ago, 2 years ago, there's no one really that wants to finance a policy at 8%. But if you're earning 7, you're technically only losing 1% to have a bank fund your policy. So 6.5, around 5, we want to lock that in. That annual loan interest we talked about goes up every year because they're putting more money into our policy. So the interest only payment we would pay would go up and up and up. Now, again, we probably want to stop funding this in 10 years and exit it some way, shape, or form, but this is just an illustration saying what if. Let's go to the next column, total cumulative loan balance. It's basically saying how much of the loan do we owe on. So first year, we owe $419,000 because the collateral assignment and the cash value. If we go down to year 10, we owe $5 million. So all that basically means is year to year, if there's any time where you're like, you know what, life changes. Plans are great. This all looks beautiful. But in 5 years, what if you strike oil and you're like, hey, I don't need this anymore. I don't want to pay on this anymore. Let's just go ahead and pay it up, get it out of my hair, and I'll start taking guaranteed income. We do one thing. If you're like, hey, I'm falling on hard times, this is not really something that I want to do anymore, we can just drop back and say, hey, this 500 grand total, 100 grand per year, let's back that off and only pay the annual loan interest for a year or two. Let you get caught back up and let's fix this thing for you. So again, over explaining, but I want you to understand this can be a very, very beautiful part of your portfolio, if not the number one part of your portfolio. But you have to understand why the Dave Ramseys, the Susie Ormans, even the cash value life insurance gurus, the reason why they don't like premium finance is they don't understand it. If you even understood 50% of what I've said so far, you are smarter than every one of those people. So just understand the reason why people don't like this is they don't understand it. The cash value collateral offset value is not really important. Cash value equity is just saying like, hey, how much do I have in my account above and beyond the bank's input? The reason why this is important is I get the question all the time. What if I want to take a loan against my policy? The bank owns your policy. Simple. They put the money in. They have to make sure that that cash value goes to them if something happens to you. If they want to call the loan, they need that money. So again, they own this. So the only thing that you can borrow against is going to be that equity. Should you? This should be the last thing that you ever touch, like literally, because this has a loan tied to it. It is quote unquote not risky, but riskier than your other things. So if you had $500,000 in a brokerage account and you could take a loan against your brokerage account for 100 grand, I would do that all day before I touch this $140,000. Policy income, this particular instance, we waited and we took a loan against our value. So our value was worth 7.18 million. We took a 6.587 loan against the value at year 16. We exited the loan without an asset. We used the cash value. And then now we are going to take $200,000 a year of income guaranteed for the rest of our life. You see all these big numbers. You see the large premium. You see the large cash value. If you're looking at 213,000 and you're saying that's not very much income, let me explain. In a taxable account, post-tax, how much you would have to net $213,000 of income per year and hope you don't run out of money because the stock market does what it does. It takes dumps all the time. It recorrects. You make the wrong trade at the wrong time. At the 4% rule, you net roughly $30,000 per $1 million. So times, let's just call it times 7. You would have to have $7 million in your portfolio to be able to net $213,000 per year. That is why this is so important, because basically you put $500,000 towards interest only payments. At year 16, we exit the loan via the cash value, and you have $213,000, equivalent to $7 million into your 401ks, IRAs, everything combined. So if you could take $500,000 over 5 years and get the same outcome as someone who saved every single dime, maxed out their 401k for 45 years, would that not be something that you're interested in? If that's the one thing you take away from this call, that's one thing that you take away from this presentation, that is all I want you to understand. So the last two columns, let's run through these really quick. Gross death benefit. This is saying after you have a death benefit, and then once you get cash value accrued, it adds to your death benefit. So it's called an increasing policy. If we take our $6 million death benefit originally and we add the 453 of cash value, our new death benefit is 6.453. Again, we talked about earlier, if we pass away year one, we have to pay the bank back. Now we will net 6.033 million. So these two columns just basically mean this is how much your policy, your death benefit would be worth. But this one is if you die during this loan period, this is what happens. So you see this drastic drop here. This is because we want to shift. When you're done funding a policy, this is what I want to say 100% of agents do and advisors. They don't do this, but it's like 99.9. I really mean it's 99.9%. They don't really care. Once they get their commission, hey, follow this, go away, take your income. I got paid. I'm going to go buy a new boat. One saying that I love is like, hey, advisors have yachts. Where are their clients' yachts? At the end of the day, that's what this is. You see a $4 million drop in your net death benefit. You're like, I don't want that. That's not cool. The reason why we're doing this is there's a thing called a reduced premium or a reduced death benefit. It just depends on which route you go with your life insurance policy. If we stop paying into our premium, there's a minimum death benefit that we need to hold that policy. So after we stop paying this in 10 years, the bank, or not the bank, but the insurance company will basically say, you don't need $6.19 million of death benefit anymore to keep this policy legal by IRS standards where it's not an investment and it's not taxable. All you need is, in this exact situation, $2.142 million of death benefit. So by doing that, you go from $6 million of death benefit, fees, expenses to $2 million of death benefit, fees, and expenses. So you're cutting the ratio of your fees by 66%. This is so important. So some people will see that and be like, man, I really wish I had that $6 million of death benefit. And it's like, cool, we can keep that $6 million of death benefit, but this number, the whole reason why you set this policy up, will not be 213. It'll be like 150. So is it worth it that if you die within these 5 years, you get $6 million of death benefit to lose out on 30% of your income in retirement? 99 point, 100%, 100% of the time they say no. We end up just doing a term policy on the side. Like, hey, what if we could do a 20-year term to make sure that by the time you're 68 years old, you'll have all that death benefit? Okay, that's the conversation. So this is premium finance in a nutshell. When you first started off and you heard everything that I said, I'm sure you're like, wow, a bank will fund my policy. A bank will give me cash value. They'll let me use their money to build up this fat cash cow. And in the meantime, I can take my money and deploy it somewhere else, especially as a business owner. Well, yeah, I want that. But then again, once you look into the details, this sounds confusing. If you picked this up 100%, you are a savant. You need to do this for a living. If you pick this up 20%, you are in that top 1% of people that I meet with. It normally takes about 5 calls of walking through every single column for people to understand this. But if I was to just give you a final note, an elevator pitch of what is this to you? Hey, Mr. Business Owner, you want to put $500,000 a year into your policy. That's fine. Would you rather take that $500,000, put it back into your business, earning 10, 20, 100% on that money because you're a professional at your business? Or would you rather put that $500,000 over here, earning 6 to 7% on your policy? I also would just want to put that back into my business. So you're saying that I don't need a policy. No, what I'm saying is, what if we could have a bank fund $500,000 a year into your policy? You pay the interest only payment. If you want to exit your business, if you want to exit an asset in 5, 7, 10 years, completely pay off that bank that funded your policy. And now you have all this cash value to become your own bank to retire early. Would that be something you're interested in? Most of the time, people say yes. So again, I appreciate you guys jumping on this video. I really, really, really would appreciate it if you would like, subscribe, follow some of my stuff. I know I hate that call to action at the very end, but this is very important to me. I'm not going anywhere. I am here to be the financial whistleblower, to crush all of these financial professionals, these CFAs, CFPs, CFFs, all the guys out there that say they're the smartest person in the room, that build their book of business off of fear. Hey, don't do that, only do this. Hey, don't do what that guy said, only do this. I don't do that. At the end of the day, a mutual fund was made for this type of client. A final expense life insurance policy was made for this type of client. A blue chip stock was made for this type of client. So there's no such thing as a bad investment or a bad direction. It's just a bad advisor that either one, they don't want to learn something new. They're a dinosaur, so they'll always just stick to what they know. Or two, they just want to sell one thing because it's easy. If I understand and I master mutual funds, all I have to do is throw all your money in a mutual fund and I make a recurring revenue. I can't say it because I'll end up getting blocked or sued or something, but there's a certain company out there that all they do is managed money. All they do is say, every dime that you have invested, let's put it into our portfolio, and I'm going to take a 1% fee per year. If you have a $10,000 balance, 1% sounds fine. If you have $1 million, 1% is 10 grand. If you have $10 million, 1% is 100 grand. So that fee starts to exponentially get higher. If you're 65 and you live to 90, that's 25 years that they're making 1% on your growing portfolio. If they do right, they almost make more money than you do. And I'm not saying this because we manage money. What I'm saying is, people that only do that, that fearmonger and say this is the right way, the only way to go, you should completely steer clear of them. So again, my name is Dustin Wiley, owner and operator of Viking Financial Group, also owner and operator of Wiley Coaching Group. So if you've watched this and you're an agent or an advisor and this is the type of stuff that you want to learn, or if you're just like, hey, in general, I don't feel like anyone around me understands anything. They're just giving me talking points and scripts to go through and just sell people trash that I don't even understand. And they even had me buy something that I don't understand. If that's you, join my coaching group, and I'd love to see you on the other side. Appreciate you guys.